Good afternoon. Shares in the Asian region were mixed, with Japanese stocks closing in negative territory, with the Nikkei down 0.7%. Mainland Chinese stocks, on the other hand, closed higher. Hong Kong's Hang Seng Index declining about 1.1% as of its final hour of trading. European stocks jumped after the Russian Defense Ministry reportedly announced that it had begun returning some troops to deployment bases after training exercises near the Ukrainian border. Locally, JC-listed Discovery says it has joined forces with Hong Kong-listed AIA Group to establish a health insurtech business called Amplify Health. To talk to us about the latest market dynamics, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. I mean, given what's happening from a global perspective, as well as some of the news announcements that we've seen of SENS, what do you make of the JC performance? How are we doing right now?
Well, I mean, we need to think about it in a kind of global context, right? You've got the S&P that's down in the region of 9% year to date. We've seen a proper sell-off across global markets in January and for the better part of February. And we're here sitting kind of flat to slightly up, depending on which index you look at. So we've held up very, very well. Obviously, a large component of that is our resource and commodity exposure. You've also got very nice momentum coming through from Richmond as well as MTN, and so far as their performance, their weightings on our index. So overall, our JC is holding up very, very well, and specifically relative to the rest of the world.
So you mentioned commodities, and I have to bring in, Ukraine-Russia tensions here. How have the commodities performed over the past week or so, at least maybe the past few days, especially when we look at the price of gold, which is often seen as a safe haven asset?
No, absolutely. So I think there's a couple of things at play. You've got what's happening out of China and the kind of stimulus that they kind of embarking on now, while the rest of the world is turning the taps off. They essentially turn the taps on. So that's very good for general commodity prices. So we've seen that come through. With regards to what's happening in the Ukraine, it's largely around what's happening to the oil price. You've seen oil pushing around $100 a barrel, which is very, very interesting, and obviously has effects from an inflation perspective as well, which is obviously a big driver of global markets at the moment. But you've also seen things like gold, like you said, as the safe haven asset, a place to go when the world seems a little bit scary. So all of these things are definitely feeding into each other. And I think at the moment, commodities seem to be a very, very good place to be putting some of your money, at least.
All right, so you mentioned inflation, and we have to, you can't talk about inflation without bringing in the Fed here. Depending on what you read, whether it's Bloomberg or Financial Times, various economists seem to be concerned that we might have a Fed policy misstep here, especially if inflation continues to tick up higher. They've got that March meeting, and we've got one more inflation print between now and then. Are you also sharing the same concerns around that policy?
I think it's always going to be a concern, right? I think there's always the ability for the Fed to essentially kill the economy. And I mean, there's the old adage of economies never die, the Fed kills them. And I think it's largely a function. I mean, think about it. It's almost like a bicycle. It needs to be going fast enough to keep you upright, but you don't be going too fast that you kind of lose control. And I think that's what they're trying to do with the economy. So it's a very, very delicate balance between making sure asset prices, inflation don't go out of control, but also making sure they don't kill growth. So there's always a potential for a misstep by the Fed. And I think we won't know until, I think, essentially we start to see the actions come through. And like you said, March is probably, in all likelihood, going to be the first time they're going to have a hiking decision to make, whether that be 25, 50, or even a percent, I don't know. And then from there, we can start to see how things unfold. And again, is inflation transitory? Are they acting too quickly? These are all things that need to play out over the next few months, but definitely the potential.
All right, so let's talk about the bond market right now. I mean, if you had to describe it in one word, given everything we've been through, at least over the past few weeks since that high inflation print from the US, how would you describe it?
Can I use a compound word? Can I say wealth creating with a hyphen in between? So essentially, bond market's a great place to be, specifically locally. I mean, We're seeing really good, very stable yields. Obviously, you get caught up a little bit in the volatility of things, but generally right now, our bond market is looking quite stable. You've got good kind of sight of where earnings are going to be from a yielding perspective. So I think it's a great building block for a lot of clients' portfolios. And also, if you look at it in context of where inflation is versus what you're getting in the bond market, call it 9.5 in the bond market. Inflation, let's put a pin in it at 5%. I mean, you're getting CPI plus 4.5 at the moment from not taking a massive amount of risk. So it's a great building block. I think it's a good spot to be putting a portion of your funds.
Locally, when we talk about earnings, there's quite a lot to look out for, whether you are interested in the local food retailers who recently released their trading updates. But we've also got the bank earnings. We had Standard Bank giving us an announcement in terms of what to expect with Liberty, but also giving us a results update in terms of the date that is. And we had Nedbank yesterday. So when we look at the bank earnings that are going to be coming up, what are you going to be looking out for?
Yeah, like you said, we had Nedbank come out yesterday, and it was to be expected in some ways because we've seen this play out over the last kind of year and a half. Our banks were incredibly well positioned from a COVID perspective insofar as the way they're provisioned and what we've seen from them in the last few months, and I expect kind of going forward now, is the releasing of those provisions, which is where you're seeing these very, very positive and very solid numbers coming from. So they've done well. I think we'll continue to see the releasing of provisions. I think growth from a kind of retail perspective and obviously a margin perspective, I think that'll come through as COVID starts to normalize, and also as we see interest rates start to pick up, because obviously when interest rates pick up, that's when banks can start to make a margin from an income perspective. So I think what I'm looking for is just to see how that provisioning or the releasing of provisions starts to normalize across the banks. But also I'm quite curious to see the sort of cheaper banks, the Standard Banks, the ABSA, the Nedbanks of the world, to see who kind of comes out in a stronger position from them, because they are without a doubt the value plays in the sector.
So these are uncertain times. I mean, where are you finding opportunities then?
So I think let's break it up into local and offshore. Locally, like I said, I think the bond market is giving you a great place to put your funds, getting a very good yield, taking a little bit of risk off the table. But I also think the JSE is also a very attractive place to be. Value is a place where people are starting to kind of trade from a global perspective, and money's flowing there. You've also got the commodity side of our index also being very attractive, and also obviously our link with China and the potential with Tencent there looking quite cheap, and hopefully us being kind of at the end of a regulatory cycle in China, which will obviously have read through into NASDAQ and process. So I still think local equities look attractive, local bonds look attractive. Globally, yeah. I think equities remain the only game in town, but I'm still very circumspect with the way that I'm investing there. And I think bottom-up stock picking and being as nimble as you can, and using the sell-offs and things, for example, Netflix the other day, to buy some really good companies at discount rates.
Martin, let's leave it there. Thank you so much for making time to chat to us. That is Martin Smith from Anchor Capital, giving us his perspectives and also telling us where he's finding opportunities. That is it from me.